Welcome to the Daily Update, where I'll go over the action in the market for Wednesday, May 10th, and then we'll see how things look for Thursday, May 11th. We had an up day. It was a positive day, but it wasn't really a gangbuster day. The markets had really been anticipating the release of the CPI report. That came in friendly on the surface, and you would think the market would have gone up on that news, and it did initially. But then we saw a lot of selling into strength, a lot of bouncing around, at least at the beginning of the day. It wasn't until later in the day when some buyers started to come in and actually take prices higher. We had fallen down to that 4,100 level. That was established as support, and then we went up from there. It's changed our short-term look a little bit more positive. Our intermediate-term look is still pretty much mixed. We have a lot of negative divergences that we're dealing with right now. And also, and I'll point this out, the NASDAQ may be breaking out above that resistance level, but we need to see more follow through if that's going to happen. Some notes before I get started. From May 11th, which is today, until May 14th, I'm still traveling. I will be leaving local time Friday night, probably traveling all Friday night into Saturday. I will likely not be able to do a weekly video. I'll do what I can to get a video posted for Monday's session. That will be a daily video. Then my hope is a little over a week from now, I can resume doing all of the other videos that I usually put together. I do have a supplemental video that I posted a few days ago talking about the relationship between stock prices and interest rates and what things we can look at to get some insight on that. You may find that helpful. I do have a podcast. It's just a carbon copy of what you're watching now. And in the description for the video, as well as the podcast, I have a PDF of all the slides and charts that I use, so you can download that and follow along. I do have a private Facebook group that you're welcome to join. And then any other platforms, I still haven't really had any feedback on that, so I'm just going to keep doing what I've been doing now. And then I won't have a poll posted this week. I may not even have one for next week. We'll see how things go with that. So right at the open, we did have a gap higher. There was initial positive reaction right after the CPI came out. We were up not a full percent, anywhere from about 0.75% to about 0.9%. So we gapped higher. We were above R3. Because Monday and Tuesday had really narrow trading ranges, that made the pivot point levels for Wednesday really close to each other. So it didn't take very much for us to get up to R3 at 41.49. Then we chopped around. There was a lot of selling into that strength. We came down. We went back up. We ended up falling down below R2 at 41.36. We then fell below R1 at 41.27. We came down below the daily pivot at 41.22. Then we initially found some support at the unchanged level, and that's a built-in support or resistance level that we quite often will hit. As the day went on, prices then rebounded back above the daily pivot and R1 before selling took prices way down below the unchanged level, below S1 at 41.14, below S2 at 41.08. We did find some support at about the 4100 level. Buying then came in, took prices back above S2, S1, the unchanged level, the daily pivot, R1, R2. We did not get back up to R3 before there was some selling going into the close. When everything was said and done, we were up 0.45% on below average volume. The technicals are turning a bit more positive now, at least in the short term. We're above that 50-period moving average because of this inflation and interest rate scenario. We're also dealing with earnings coming out. We're hearing a little bit more talk in the news about the debt ceiling, mainly because of what Janet Yellen said last weekend, that, hey, we need to get on the stick here. We might run into some problems. They'll probably come to a solution, but they're going to do their political posturing back and forth. And then we're still waiting to see if there'll be any more banking information that will come out. What are some comments that we can make? Initial reaction was favorable to the CPI report, but this quickly led to uncertainty. That's what I feared when I made yesterday's video, that we're not really going to see a big up move or down move. There's going to be something that comes in that the market chooses to say, yeah, today's report was okay, but now they're developing some uncertainty about the Fed's policy path. Are they going to keep rates where they're at? Are they going to keep having to raise interest rates? Because the core CPI reading isn't enough to convince the Fed to cut rates anytime soon. The debt ceiling continues to be a concern, as well as now there are some fears starting to come in that we may have a hard landing. The dollar was up and interest rates were down. The 10 to the 5 and the 30 to the 5 remain normal, where the 10 to the 2 and the 10 to the 3 month are still inverted. Sentiment is positive, still unchanged at 60, where it had been at 60. Our trend is positive. With the up day, the green line turned back up, so it is strengthening a bit, but the ADX is weakening. It's still below its moving average, and both of those are below 20. Our bias is positive with the up day, and I'm still keeping our momentum at mixed. The economic reports that came out, we had the weekly MBA mortgage applications index. It came in up 6.3%. Refinancing applications were up 10%. Purchase applications were up 5%. Then the total CPI came out. This was at 0.4. They had expected it to come in about at 0.4 on a month-over-month basis. On a year-over-year basis, they had expected it to come in at 5%. It came in at 4.9% year-over-year. When you look at core CPI, which takes out food and energy, it came in up 0.4% month-over-month, a little bit more than the 0.3% they had expected. This is what the markets decided to say, wait a minute here. And then this still equates to 5.5% on a year-over-year basis, although it did tick down from last time where it came in at 5.6%. The index for shelter, this is what people have to pay to live places. It was up 0.4%, but it was down from the previous reading. The Treasury budget also came out, not a real big mover as far as the markets are concerned. It had a surplus of $176.2 billion compared to a surplus of $308 billion a year ago. Here's a little more of a look at CPI. This is the headline number right here, and I have a bit of a definition on the chart where you can pause this and read through that. I just went to Investopedia to get this definition, but this shows how it has been coming down when we place a rate of change going back 12 months. So it shows that inflation is decreasing, and then on a month-over-month basis actually has ticked up just a little bit. And then we look at the core CPI, which takes out food and energy. It also has been coming down, and it was up to slightly sideways with the rate of change going back 1 month. Now, this is where we look at something that's kind of interesting. If you go to a site called shadowstats.com, they post charts that say, okay, on the left, this is how we calculated CPI back in 1990. That's the blue line. And we would be at about maybe 8.5% to 9%. I don't actually get a number for this chart. The interesting thing is, if you go back to 1980 and how we calculated CPI at that time, we would be at 12.9%. Yes, it's coming down, but it's still pretty high overall. And if you talk to a lot of folks, this is probably more realistic of what's actually happening day in and day out. Now, let's go back and look at some of our charts. The intraday chart showing how we did gap higher above R1, R2. We busted above R3, but we didn't stay there for very long. Chopped mainly down below the daily pivot, down to the unchanged level. Tried to bounce up off of that. That wasn't working out. This is when the real selling wave came in. We came down to the 4,100 level, set up a bit of a base, and then we saw some late day strength, taking price back above the unchanged level, the daily pivot, R1, R2, never made it up to R3, and then some selling going into the close. Here's the intraday chart, where before the report was released, we were looking more negative. Then the report came out, everything shot more positive. Then the SPY danced all around with everything else. Right now, we're up a little bit in the pre-market hours. We'll have to see if that can carry through into the open. Large cap growth is continuing to outperform large cap value, and here are the closing numbers, where growth was up 0.66% versus being up 0.22% for value. The mid caps also saw growth outperforming, as well as small caps. So that bodes better for the scenario that maybe folks are starting to get back into growth stocks. Looking at sentiment, our Ulcer Index really hasn't changed all that much. With the update, it ticked down slightly, showing that there's not a lot of fear in the market. The VIX also came down with the line chart as well as the bar chart. The VIX of the VIX actually spiked up a little bit with the gyrations that we saw during the day, so volatility might be picking up just slightly. The fear gauge that we look at ticked down, but it still has been going up overall. And the other fear gauge that we look at has been pretty much sideways, but it did tick down slightly. Folks are still favoring a risk-off posture, meaning they're getting out of stocks and getting into bonds. Looking at some advanced decline line studies, we went pretty much sideways based on price. We declined a little bit based on volume. That's shorter term. Longer term, we still have this negative divergence where price had been going up, but volume was not matching that. Then looking at the new highs, new lows, they did break out just a little bit on the 1-day basis, but we're not really turning back up yet with the 5 period, and we're pretty much flat with the 10 period. The advanced decline ratio is pretty much neutral right now. The red line's a little above 0 and the blue line's a little below 0. Accumulation distribution is still above an advancing moving average, so that's positive. Our broader range, we're still pretty much on top of the moving average with the NYSE. The S&P was flat. The mid caps were flat to slightly under the moving average. We turned up just a little bit with the small caps. Then looking at the NYSE studies compared to the S&P, we're still seeing this negative divergence with the cumulative advanced decline line as well as the regular advanced decline line. But when you take the advanced decline line by itself, it's still holding up fairly well. When you look at common stock, we're still seeing this negative divergence where common stock, based on price, did make a higher low, but based on volume, it made a lower low. Looking at our trend, here's the ADX. That's the thick black line. It continues to go down. It's below the moving average. The green line is on top and went up a little bit, so it's strengthening, but not by very much. However, we still remain in a trendless environment. Volume continues to drop off. On a short-term basis, really didn't make much of a difference with the chart. We didn't really break through any resistance. You can see on the bottom where volume has dropped to below average. On a positive side, though, we did close back above the 20-period simple moving average. So in the short term, that turns things more positive. Looking at our stochastics, we're above the midpoint and advancing in the short term. Intermediate short term, we're still looking pretty good, but we're still declining with the long short term. And the reason I say that is this is a further subdivision of the short term. So we have really, really short term, kind of short term, and then longer short term, if that makes sense. The force index is still slightly above 0. That's positive. Now switching to some intermediate term charts, we still declined with the balance of power. We were able to close right back about at the triple exponential moving average. That may be providing a little bit of overhead resistance. The go, no-go system remains at neutral. The TTM squeeze is still looking more negative and has been chopping sideways. The PPO study, we're positive in the long term. Intermediate term, we're positive, but we're turning down a little bit. We're still coming down slightly in the short term. Our Arun indicator has also turned more negative. The McClellan oscillator, we're still below 0 even though we ticked up, and we're working off of this negative divergence. We're also seeing this negative divergence when we take the broad measure, the NYSE McClellan oscillator, and even though it ticked up slightly, it's still below 0. The Swollen Trading Oscillator, based on price, has turned back up, but it's below 0, and the same thing is true for volume. We're still working off of a longer-term negative divergence here. The PMO study is still negative, both based on price and volume, and our indicator is still below the moving average. The PMOs that are rising, we're also working off of a negative divergence here. It ticked back up. We were flat to slightly down with the buy signals, and we're also flat with the PMOs that are above 0. The Elder Impulse system for the S&P remains positive. The parabolic SAR, however, remains negative. All of our oscillators continue to be negative, and as I pointed out in yesterday's video, we'll be watching the slope oscillator first. It's the most sensitive, and if it's going to start to show some improvement, it tends to lead some of our other oscillators. We're now above all the plotted moving averages in the moving average tree. This is another concern. On an up day, we still saw the BPI decline and we're right at 50. That's the midpoint. If we drop below 50, that's more negative. We're also seeing a negative divergence here where the S&P was going up, but the BPI was not matching that. The NYSE bullish percent index also remains negative. It ticked up, but it's still below 50. The Chaikin money flow did show a little bit of improvement. And the Chaikin oscillator is just a little bit above the midpoint, so it's slightly positive. The money flow index did turn up, but it's still below 50. The ultimate oscillator is just barely above 50, so that's slightly positive. The vortex, we're seeing the red line coming down and the green line coming up, but they have not crossed yet. On balance volume, we're still below a declining moving average. The summation index based on price is declining and based on volume, and we're also working off of this negative divergence. When we look at the percent of stocks above their 200-day moving average, we're also seeing a negative divergence as well as a negative divergence with those percent of stocks that are above their 50-period moving average. And here's another look at that same chart. Looking at some line studies, we were able to get slightly above the 41.23 level and close at that level. So that's positive in the short term. Longer term, and I finally went in here and figured out what is this number right here. And this little tilde thing, that means approximately 41.70. Can we get above that? The S&P closed at 41.37. The high for the day was at 41.54. If we really get some strength underneath price, can we get above the 41.70 level and then close at that level? Longer term, we have not been able to come back up to this 50% retracement at 41.56, which may provide overhead resistance. And if we do start to fall, we do have support at 40.20. Also looking at this resistance going back to the two major lows set in 2022 and then drawing a parallel line going back to the all-time high, we do have some upper resistance right here, but we really haven't reached that level. We wouldn't really start to hit this until the S&P got to 4,200 or so. Our different charts, the Heikin Ashi is looking more positive. The Kegi is still negative, but the red line is pointing up, and the three-line break is positive. Looking at our different indexes, the equal weight index continues to underperform the S&P 500. Our new take on Dow theory, we're still above this blue line for the S&P, and we might be getting ready to break out now with the NASDAQ. Can it stay above that level? The transports continue to underperform the Dow. The Dow is right at this S1 level where it closed. It's also having some real strong resistance at the monthly pivot level. The diamonds have remained at neutral. The NASDAQ, I drew a red line here to show that we did close just barely above what had been resistance. Now we'll be waiting to see, can the NASDAQ have another up day and start to add to those gains, or is it going to show some weakness and drop back down? The NASDAQ 100 also had a pretty good day and looks like it could be breaking out, but we need to see follow-through price action. The Elder Impulse system for the Qs is positive, and we're still above support at this anchored moving average going back to the all-time high for the Qs. We're still above this 38.2% retracement level for the NASDAQ 100. If we fall, we'll be watching that level. The small caps continue to be negative even though they were up in Wednesday's session. The Russell is still right at the RSI 50 point, so that's the midpoint. The MACD is trying to turn back up and trying to go positive, but we're just not seeing that yet. Small caps continue to underperform the S&P 500. The small caps for the Elder Impulse system remain at neutral, and the mid caps, we're seeing a death cross here below the pivot point, so we need to see some more follow-through action with mid caps to help support the rest of the market, and that's just not happening yet. The Elder Impulse system for the mid caps remains at neutral. The micro caps were up fairly well in Wednesday's session and have not set a new 52-week low. The home builders continue to show some improvement overall. The ratio is still doing pretty good, but now we're starting to see them outperform the rest of the S&P 500, so this relationship is slowing down a bit. Looking at the bank sectors, we were down over 0.5% in the financial sector overall. The financials continue to underperform the S&P. The regional banking ETF is underperforming the financial sector. And then our longer term look at interest rates, really nothing was decided here. We're seeing, can we break out above the rainbow? That would signal more of a soft landing scenario for the markets. If we break down below the rainbow, that would signal more of a hard landing economically. Looking at bonds, the long-term relationship between the S&P and the long-term bond is still pretty strong overall. Short-term, it is improving. where they had been moving in opposite directions from each other, and the spread is still pretty wide between the two. Bond yields were down in Wednesday's session, and bond prices were up. Long term, we're still looking at this special K here. It's dropping back below the moving average now. For this to turn longer term positive, we would need to go back above this red line. Our long-term trend, the MACD, is still above zero and advancing, suggesting that this breakout above the trend line is legitimate. An update of our possible positive scenarios. The Qs did outperform the S&P, so that's looking a little better. Discretionary is just a little bit above the moving average. Large cap growth did outperform large cap value. Our growth to value ratios, the large cap looking a little better, mid caps better, and the small caps showed a little bit of improvement. The utilities, however, continue to underperform the S&P 500. And looking at our broad range of the Amex, NASDAQ, and NYSE, we're still below zero with the 5-period moving average of the highs minus the lows. Longer term, though, we're still holding up with our 50-period exponential moving average of the new highs minus the lows. This red line is still above zero, even though it did tick down slightly. The indicator itself is still above zero, giving a current reading of 3. The 2-year Treasury yield, it's starting to come back down. Will that give some support to the S&P 500? Our staples also coming back down slightly. Will this be a spike that, if this relationship continues to fall, will often give support to the S&P 500? So what's our outlook for Thursday? Earnings season is still happening right now. The PPI is coming out on Thursday. The technicals are mixed. Shorter term, we're looking a little more positive. Intermediate terms, where we're really kind of mixed up right now. Longer term, we're still positive as long as we're above that 200-day simple moving average. We do have the PPI coming out and weekly jobless claims, the whole list of geopolitical events, inflation and interest rates, earnings that are due out, and then any more talk about the debt ceiling situation as well as the banking problems. Looking at the Stock Traders Almanac statistics for May 11th, this is pretty negative overall. The Dow and the S&P are only up 33.33% of the time. The Nasdaq's a little bit better, but it's only up 42.9% of the time. And then looking at this next chart, this provides the positive backdrop that applies to the whole year for the markets. So our scenarios, tough to go with the down one right now. Tough to go with the up one right now. So we're still tending to favor the sideways pattern because the ADX is weakening. It's still below its moving average, and both of them are below 20. It is positive, and with the update, the green line did advance. So our warning signs, the numerous negative divergences, they're still combining with each other. The VIX is still showing a lot of complacency. The S&P continues to underperform utilities. We're still in a risk-off posture. Small caps continue to underperform, and then earnings season, which, as I usually say, can either be positive or negative. On the positive side, the longer-term positive seasonality and those setups, they're still there, and they will apply for the whole year. If we do start to fall, we have some pretty significant support levels. And then on the positive side, the NASDAQ may be breaking above resistance. We'll have to see if we can get some more follow-through upward action. So our conclusion. The S&P is mixed, it's not trending, and it's showing a lot of negative divergences. Short term, we switch back to being positive. Intermediate term, we're mixed to positive. Long term, we still remain positive. So thank you. I hope you found this video helpful. I hope you have a really good day, and I will talk to you in the next video.